You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, last week we took some time out to answer some of your listener questions, which was wonderful. I think those are some of my favorite shows to do. First of all, I get to team up with Mark Longo, and that's always fun. And then to go along with it, it gives us that opportunity just to know that you guys are so involved, and the questions that we receive are honestly very astute from this entire crowd. So thank you for the kudos, because we got a lot of got a lot of love from the last Options Playbook Radio. So keep bringing the love. We like that. Valentine's Day is right around the corner, not that far away now. But with that said, I am a little bit under the weather. My voice is a little bit harsh right now. And so going into Options Playbook Radio, I was trying to figure out, well, what type of trade will I do today, being a little bit under the weather? And I just realized that when we talked about ROKU and we talked about Boeing, and we've been doing a lot of long straddles, that the marketplace, that volatility is still there. We've had a good move up in the S&P 500 index recently. We're getting into December. Last year we had a very nerve-wracking December, but this year, let's hope it's going to be a little bit different. But I noticed that I went into the Ally Invest platform, and there is a way to set an alert that if a stock moves 5%, you just continually get that alert. It doesn't go away until you stop it. And so I had the ROKU Straddle on because of Options Playbook Radio. And man, I swear to you, almost every single day, it seems like I keep getting that repeat alert. I keep saying I'm going to go turn that off because I no longer am looking at ROKU as a long straddle. And every day I keep getting the alert again. So guess what? The gods have spoken. They want me to talk about a long straddle in ROKU again. We're going into the holiday season. I'm like, well, why not? Let's do a rinse and repeat, and let's talk about long straddles. Now, a lot of people, if you've looked at my last episodes, must think that I love long straddles. But honestly, that just is not the case. In general, long straddles are not a big part of my trading portfolio. I think they're extremely speculative, but I do have specific rules that are behind them. If I'm doing long straddles, I never want to do them around a known event. I'd much rather do it and avoid the earning event because you got to pay for them. A known event means that the options are going to be priced accordingly. And a lot of times, to be blunt, I've very rarely seen an earnings report where the implied volatility increased after the earnings report. So what does that say to me? That usually means that the options are really overpriced going into the earnings. Most of the time that is the case. Every once in a while you don't get that, but they seem to err to too much volatility as opposed to not enough. So with that said, I'm going to start by looking at the ROKU chart. So I got all these alerts. I keep getting this alert, and I finally went and turned off that alert inside the Ally Invest alert platform. And now I'm going to turn it back on again with that said after today's radio program. But with this said, okay, let's just look at this. ROKU, we're taping Options Playbook Radio on December 4th. It is a Wednesday. The markets are closed. I'm looking at the Ally Invest volatility chart, and this just kind of confirms why I've been receiving those alerts that I've been talking about, in that I look at the implied volatility on a 30-day basis. We get this number from ivolatility.com, and it's saying that the weighted index, they basically calculate a 30-day implied volatility for a specific stock, and then we compare it to a 30-day historical volatility. So you're comparing apples to apples. And if you look at this, the IV index, I'm going to just round up. I'll say the mean from November to December has been about a 60% implied volatility on the IV index. And if I look at the actual volatility, the 30-day actual volatility, I see a much wider range and a much higher range. We're looking at the ranges between 75 and 85, and even gone up and touched 90 a few times. So this is without any earnings, right? The next earnings report is in February, I think, at some point in time. I looked at it. I don't remember the exact date. But that is just not in our wheelhouse. So it's not earnings. And the marketplace has just got the volatility wrong. It's that simple. We got implied volatility has stayed steady around 60. Historical volatility has been up in the 80s. This has definitely been a case where we've had more volatility than the marketplace was expecting. Hence the reason why I've been getting all these alerts on my phones, because of all the 5% moves in ROKU just over the last month. So let's hope that they continue. So here's what we're going to do. If I look at the ROKU, I like to stay in the monthly option contracts just whenever I'm trading. If I get that opportunity, I do. ROKU is a fairly liquid stock. Well, it's a very liquid stock, and the option contracts are also fairly liquid too. You get decent markets on them, but you do have halfway decent implied volatility, which has a tendency to widen the markets a little bit. We're seeing the vol on the December 20th expiration, right before Christmas. So I don't want you to get bogged down before the holidays, so it's right before Christmas. That vol is trading right around 60 vol, which is about where the 30-day is at. And the stock closed today up $5.95. Let's call it $6. And the last trade was 150.58. 150.58. So the most at-the-money straddle, that's what we're always looking at. I don't like to do strangles. If I'm buying them, I want to buy something at the money. So one of those option contracts is going to have intrinsic value if you're correct on your forecast and it goes in a specific direction. But we see the most at-the-money put, which is a little bit out of the money, is trading for $7.85 on the ask, and the most at-the-money call, the 150 call, is trading for $8.60 on the ask. It's a little bit in the money. The net debit is $16.25 at the midpoint. At the midpoint, it's $16.25. So if we do this trade, we are hoping that ROKU in one direction goes at least $16.25. That's our whole goal. If you don't think that it can do that, then you're not going to do the trade. So has ROKU done this recently? And the answer is obviously yes, from basically what I have been saying at the whole lead into the rinse and repeat scenario. If we just go back to September, before major news came out that some cable companies are going to offer a box, a ROKU-style box to all of their cable subscribers. That's at that point in time, the stock was trading at 170. Over, I guess I'm going to say a month, it drug itself down to about 100. And I'm going to round off on all these numbers. Then it came roaring on back, went to 130. Then the next stopping point was 160. And then I see back down to 120. Now it's back up to 160 again. It hung out at 160 for a little bit, but then made a big move down to 135, and now it's back up to 150. All right. And those are just this. You just pull up a chart. It's really been crazy. Obviously, 15-point moves have not been hard for this stock. And the one thing that's been interesting about it is the moves are dramatic in one direction. They don't go down 5, up 10, down 2, down 3, down 5, down 10, up 15. They're either going up or the stock's going down. And that's what you kind of want on a long straddle. Now, 60% implied volatility still means there's risk in this. Long straddles aren't for the light of heart. They do have risk. You're paying up for premium. That's why a lot of people just don't, in general, like to do them. But with that said, 1625 is the midpoint. That's going to be our paper trade for this week. We are, as always on Options Playbook Radio, it's not meant to be a recommendation. I want you to follow this. The expiration is right before December, so it's not even going to bother your holidays. See what the underlying stock does. See if it makes a 16-point move in one direction. Now, my rule has always been, if I'm doing a long straddle, I don't mind legging out of it at all. I don't mind that at all. But I'm going to make sure that put pays for the call or that call pays for the put. So I am not going to leg out of this trade unless the call is trading for at least 16.25, basically what I paid for it. I would really want to leg out more so if it was around 18 or 19, but you never know. It's all about where the market is at that point in time, and I think that long straddles are really about the feel for the underlying market at the time that you're thinking about getting out of the trade. So if I look at this, 1625 is where I would be willing to sell a call or I'd be willing to sell a put. And also realize that if you're doing this trade, the odds of you losing that 1625 are very minimal, because basically what has to happen is the stock has to go out right on December 20th, right at the 150 strike. Right? Let's say that again. In order for us to lose the 1625, you have to ride this all the way to expiration, December 20th, and you have to do absolutely nothing, trade out of anything, and the stock has to stop right at 150. If it's 151.01, you at least made a penny on it, right? Because one of the option contracts is going to be in the money. And so that greatly reduces the risk. If I was going to do this trade, I would probably we're going to do 16 days, and just off the top of my head, I would say within 5 days, I would think hard of just getting out of this trade. So I really got 11 days for this thing to make the move. Depending on where the stock is at, I might wait till the fourth day, but I am not riding it all the way to the end. I'm going to have a hard stop as far as the day is concerned. And then, now I'm going to throw in a little twist. Because there's so much volatility, I could also just look at the December 13th expiration, which is 7 days before, and I can go way out of the money. Like in this instance, I could sell a 170 call, which is 20 points higher. Obviously, I'd be happy if I could sell my entire straddle for 20, paying 16.25. And then on the downside, I could go 20 points lower and sell the 130 put. And I can get that done for a net credit of $2 to the account. So a different approach to this is to do the long straddle. And I think I had somebody bring up a listener question about this last week, just in general. Why would I do this? Well, they actually kind of called it a butterfly time spread or something like that. But I just look at it as I'm doing a long straddle and I want to sell off some of the risk. And so I'm okay if I do this as long as the width of my spread is a profitable width if the stock makes the move. In other words, if I paid $16.25 for this straddle, I don't want to sell a 15-point wide spread against it on the call side or on the put side. I want to be more than 15 points. Why? Because I paid $16.25 for the straddle. So that's just the way that I would approach it. $2 is nothing to sneeze at. So if you want to, and you want to do it and lower a little bit of the risk, you buy the long straddle for $16.25. You sell the strangle 1 week prior with the December 13 expiration. You take $2 off of that. Now you're at $14.25 on the total risk. And the only way that you lose is if you're the most unlucky person in the world and the stock goes out right at 150, right at the expiration date. All right. So let's come back in a week's time. We're getting close to the holiday season, but we'll be back next week. We'll look at how ROKU is done, and we'll look at a new trade for next week. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. And until then, may all the options you bought finish into money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.